Imagine waking up tomorrow and hearing that one of the richest countries on earth has finally paid off all of its national debt. No more government borrowing. No more bonds. No more interest payments. At first, it sounds like incredible news. A responsible government, a stronger economy, a brighter future. But within months, something strange begins happening. Banks struggle to find safe places for their money. Pension funds start panicking. Insurance companies lose one of their most important assets. Financial markets become unstable. And the same country that proudly became debt-free quietly starts borrowing again. It sounds backwards. After all, we've been taught that debt is a problem. Families try to pay off debt. Businesses celebrate becoming debt-free. So why can't some of the richest governments on earth do the same? Why do countries with enormous wealth, advanced industries, and powerful currencies continue borrowing trillions of dollars every single year? The answer isn't about politicians being irresponsible. It's about how the modern financial system was quietly built. And once you understand that system, you'll never look at government debt the same way again. Because for some countries, debt isn't just money they owe. It's one of the products they sell. To understand this, forget governments for a moment. Imagine the safest warehouse in your city. Everyone trusts it. Families store jewelry there. Central banks hold them. Retirement funds hold them. Insurance companies hold them. Foreign governments hold them. Not because everyone loves lending money, because everyone desperately needs something they can trust. Imagine managing hundreds of billions of dollars. You can't hide it under a mattress. You can't leave it all as cash. You need somewhere stable. Government debt becomes that place. Now the story gets stranger. Suppose tomorrow every rich country announced that they were paying back every bond they had ever issued. Sounds responsible, but where would trillions of dollars go? Investors would begin searching for alternatives. Corporate bonds? Riskier. Stocks? Too volatile. Real estate? Too illiquid. Gold? It doesn't generate income. Suddenly, the safest asset in the financial system disappears. And everyone starts fighting over what's left. Prices become distorted. Markets become unstable. Ironically, removing debt could make the system more dangerous. This is where most people misunderstand national debt. They imagine one giant credit card bill. Reality looks nothing like that. Governments rarely pay off all their debt. Instead, they refinance it. Picture a homeowner with a long mortgage. Every few years, they refinance on new terms. The old loan disappears. A new one replaces it. Governments do something similar. When old bonds mature, they usually issue new ones. The debt continues, not because they forgot to pay, because the market wants them to keep issuing safe assets. That's why countries with excellent credit often borrow more easily than countries with little debt. It sounds absurd. The safest borrower is often the one who never stops borrowing. Now, think about the size of this system. Global government debt has climbed into tens of trillions of dollars. That number sounds terrifying. And yes, excessive borrowing can absolutely become dangerous. History is full of governments that borrowed too much. Some experienced inflation. Others defaulted. Some destroyed their currencies. Debt is not harmless. But here's the important distinction. There's a huge difference between borrowing in a currency you control and borrowing in someone else's currency. Imagine you owe your neighbor apples. You own an apple farm. Producing apples is difficult, but possible. Now imagine you owe your neighbor diamonds, and you don't own a diamond mine. Your situation is much riskier. Countries with their own strong currencies have more flexibility. Countries borrowing in foreign currencies often don't. That's one reason why wealthy nations can sustain debt levels that would cripple smaller economies. It's not just the amount. It's who owes it and what currency it's denominated in. But debt serves another hidden purpose. It quietly helps determine interest rates across the economy. Imagine government bonds disappearing. How would banks decide mortgage rates? How would companies price corporate loans? How would investors measure risk? Government bond yields act like a ruler. Everything else gets measured against them. Without that ruler, pricing becomes far more difficult. This is why central banks constantly watch government bond markets. They're not just observing government finances. They're watching the foundation beneath almost every financial decision. Then there's another twist. Many countries don't simply tolerate other nations' debt. They actively buy it. Japan owns foreign government bonds. China owns foreign government bonds. Pension funds across Europe own American Treasury securities. Why? Because global trade creates enormous pools of money looking for safe homes. Imagine exporting products worth hundreds of billions of dollars. Eventually, you receive huge amounts of foreign currency. Leaving all that cash idle isn't practical. Buying government bonds becomes one of the simplest solutions. Suddenly, debt isn't just borrowing. It's also an international savings account. This creates a fascinating cycle. Governments issue bonds. Investors buy them. Banks use them as collateral. Central banks use them in monetary policy. Businesses use their yields to price loans. Retirement funds depend on them. Foreign countries store reserves inside them. The debt circulates through the entire financial system. Remove one piece, and countless others start wobbling. That's why reducing debt is much harder than politicians often suggest. Cut spending too aggressively. Economic growth may slow. Raise taxes too quickly. Consumers and businesses may spend less. Issue fewer bonds. Financial institutions lose safe assets. There are trade-offs everywhere. Sometimes governments genuinely need to reduce deficits. Sometimes they absolutely borrow too much. But the goal usually isn't reaching zero debt. It's keeping debt sustainable. Those are two completely different ideas. Think about the irony. When households eliminate debt, they usually become financially stronger. When some governments eliminated all debt, the financial system itself might become weaker. That's because government debt isn't only a liability. For someone else, it's an asset. One person's debt is another person's investment. Scale that idea up to trillions of dollars. And suddenly the entire global economy starts making more sense. Of course, none of this means governments have unlimited freedom. Confidence still matters. If investors stop believing a government can manage its finances, borrowing costs rise. Higher borrowing costs increase interest payments. Larger interest payments require more borrowing. That spiral has damaged many economies throughout history. Trust is everything. Government debt works until people stop believing it will. And that's the balancing act every major economy faces. Borrow enough to keep the system functioning, but not so much that confidence begins to crack. It's a line no government can see, only discover after crossing it. Which leaves us with a question that may define the next decade. If the world's richest countries can't realistically get rid of their debt, then the real question isn't whether they should eliminate it. It's whether anyone truly knows how much debt the world can safely live with before the system that depends on it starts depending on faith instead.